Students, Assalamu alaikum. My name is Dr. Athir Iqbal. In this lecture of portfolio management, I will discuss the correlation of single stock with respect to market. That if we are taking KC 100 index, or in case if we are taking any other index of the market, and we are finding its correlation with any particular stock. As well as we will also discuss the concept of systematic risk when we are working with a stock, as well as in the KC 100 index or any other index, whatever you are taking. This is not necessary that you always take KC 100 index. If you are working on any international portfolio market, then you can also take index from that place. But this is important to understand that what is the concept of systematic risk and how it's going to impact on the portfolio that you are planning to make. So student, in this lecture, we will cover correlation with market of various stocks, as well as understanding of systematic risk calculation. Overall risk is divided into two components, as you can see: systematic risk and unsystematic risk. Risk that can be diversified away by making portfolio is called unique risk, which is related to a specific stock, and this can be eliminated with the help of a diversified portfolio. So on this slide, the term unique risk or unique part can also be taken as a diversifiable risk. While there is another risk which is called systematic risk, is related to economy and cannot be eliminated. So this which is presented by beta is the risk which cannot be eliminated. This is the reason that this risk is also called undiversifiable risk. So in this regression equation, beta is taken as systematic risk that must be borne by investor, and unsystematic risk can be eliminated. As you are now familiar how to calculate correlation between two stocks, in similar fashion, now you can calculate correlation between stock market index and any portfolio specific stock. You need only two information for this purpose: the one, index values, and second, the stock price of a specific stock for which you are interested to calculate correlation. Student, in this slide, I'm presenting it again because it has already been covered in the previous lecture. I'm showing you KC 100 index values and various stock prices. Of course, I'm not showing working here, but it will help you how to get idea about the correlation and standard deviation that you have worked so far. Look, I calculated the standard deviation of each stock. As you can see that these risk is different in each stock. You can see that least standard deviation in isolation is in the price of DG Khan Cement, while highest standard deviation is in the price of PPL. Then we calculated correlation of each stock with KC 100 index, and here you can observe that behavior of each stock is different. Not the last one, but you can see the least correlation that we find is between market and Honda car company, which is coming 0.55 years, and the highest correlation with the market is coming in the OGDC 0.95. One thing here is important, that similar kind of behavior does not exist at all time. It may vary from time to time as market sentiments and economic indicators change. So this is not necessary that whenever you will calculate correlation between these companies and market, you will find similar kind of correlation result. The results may vary from time to time, and seasonal impact may also come on it. Student, this is somehow look very tricky, but if you keep some concentration and you have a basic understanding of a graph, then you can easily understand this one. If we examine different two assets combination and drive the curves assuming all the possible weights, we can find a graph like this, and you can see that the curve is rising over here, and this curve is showing that if you are keeping various risk in terms of standard deviation on the x-axis and you are keeping return on the y-axis,
if you will plot risk over here and return on the Y, then various stocks or various portfolio will give you different return and risk. Specifically, you will find that one stock as compared to market is coming over here, another stock is coming over here, and the third stock might be is coming over here. It means that different stocks can give you different standard deviation and different return. The front line which is coming over here, this edge is taken as a efficient frontier. The efficient frontier represents that set of portfolios that has the maximum rate of return for every given level of risk, or the minimum risk for every level of return. Just assume that one stock is coming over here, and another stock is taking the same risk but is rising over here. So naturally, this stock is giving you more return as compared to the one which is rising over here. We would say that portfolio A in graph dominates portfolio C, because if you look at the portfolio C, you can see that portfolio C and A both are giving you same return, but the risk of portfolio C is more than portfolio A. So if I ask you which one should be taken, would you like to take C or would you like to take A? So naturally your answer should come in favor of A, because A is taking less risk and giving you the same return, while the C is uh, giving you more risk and giving you the same return. Similarly, if you check the portfolio B dominates portfolio C again. Again check, portfolio C is giving you risk is this much, but the return is coming here. In portfolio B, again you are taking the same risk, but your return will be coming over here. So naturally, rather than taking this return, you would prefer to go to this return when you are facing the similar kind of risk. Because of the benefits of diversification among imperfectly correlated assets, we would expect the efficient frontier to be made up of portfolios of investment rather than individual securities. Two possible exceptions arise at the end of points, which represents the assets with the highest return and the assets with the lowest risk. As an investor, you will target a point along the efficient frontier based on your utility function. Means you will try to keep yourself over here rather than inside of this graph. All of these portfolios have different return and risk measure, which expected rate of return that increase with higher risk. This is again here just to remind you that this is really very important. That's why I pointed out again over here that whatever portfolio you are making, successful portfolio should focus on minimizing the risk. This is the reason that diversification plays very, very important role in the portfolio making. Later on in the entire finance, you will see that it will play a very important role. And if you cannot manage to reduce the risk of your portfolio, then there is no need to make portfolio, and that portfolio will give you no better return. Actually, we will cover this topic on Excel in online classes, but here I am only showing you the basic process that if you are interested to calculate systematic risk, which is also called beta, then what information you will need and what process you will apply on Excel. You need two information. One is market index values and second is specific stock prices. Systematic risk of the market is one. This we can calculate with the help of covariance of the market with itself, as you can see over here, and divided by the variance of the market. For systematic risk of a stock, we will take covariance of the market with a stock and will divide by the variance of the market. Resulting answer is 1.16. Remember, this is important to keep in mind that more than one systematic risk means it is more risky as compared to the market. And in case if you get any bit of a stock which is less than one, then you can call it as a less risky compared to the market.